Hey, my name's Josh. I'm one of the partners and accountants at Figures, and Figures is your all-in-one accounting solution. Before starting Figures, I worked at EY, I worked at Barclays and Crown Agents Bank. And in today's video, we're going to look at something called ATED, which stands for Annual Tax on Enveloped Dwellings. Can't even say that. Annual Tax on Enveloped Dwellings. And the best way to think about it is it's an annual tax on properties in a limited company structure. So that's the translation for it. I don't know why they make it so complex, but it's if you've got properties and in a limited company. So we're going to go through what it is and if it applies to you. Let me make my head a bit smaller. So something to note is that ATED has been enforced since 1st of April 2013. If your company has owned residential properties above 500k since then, the clock has already been running. And the reason I point this out is because it also captures properties which were moved to a limited company but before this date. So if I give an example, if you had a property and you moved it to a limited company in 1995, you would still be caught today. So this tax looks back retrospectively as well as for future days future from this date here. So basically, regardless of when you moved your property into a limited company, this tax will apply to you. So what is this tax, how much is it going to charge, and who is in scope? So it's an annual charge on UK residential property owned by a company. Threshold, any property worth 500,000 lowered from 2 million at launch. So in 2013 it was 2 million, then it went down to 1 million, and now it's at 500,000. So its charge is based on value band and is uplifted by HMRC each tax year. So basically this charge changes each tax year. And these are the different bands that you can fall into. And something important to understand is that if your property is worth £501,000, you still get the annual charge of £4,620. If your property is worth £999,000, you still get charged £4,620. So regardless of where your property sits in this band, this is the charge, and so on and so forth. It's important to note it's not a sliding scale, it is a charge based on the bucket that your property value falls into. So there are some reliefs and ways to not pay this tax, and these are probably the most common ways, which I've listed them here. We've got some other use cases as well, but I'll run through each in more detail. So number one, if you have a property rental business. So let to an unconnected third party at a genuine market rate. This is the most common relief, reduces the annual charge to nil. So obviously if you're lending to somebody down the road and you don't know who they are, and again it's at a fair market rate, you are exempt from this. If you're a property developer acquiring with a genuine demonstrable intent to develop and sell, the property must not be used as a dwelling during the development. Again, you're exempt. Other qualifying cases include property trading businesses, farmhouses, charitable use, and accommodation for qualifying employees. And the reason being for this is the tax is mainly there to tax people who have a second or third property, and it's just their dormant. It's like a holiday home, and nobody's using it for 51 weeks of the year, so they're just there for 1 week or whatever it may be. But if it's used for a business purpose, you get relief from HMRC. And the best way to think about this is if you're a property trading business or you're a property developer or property rental business, this property is an asset on your balance sheet. And specifically for a property trading business or a property developer, if I use an example, if you are selling candles, you buy the raw materials, so you got the wax, you got the wicks, the jars, all that kind of stuff. HMRC would say, you know what, for you in your business specifically, property is like inventory, it's like stock. So if you're trading properties, buying and selling properties, it's like stock. You're not using it to live, you're not using it to sort of house your mates, your family at a discounted rate. You're using it for the purpose of business. And if you use it for the purpose of business, there is relief available. So I put together a little table here, so it shows you ATED relief applies, and then relief does not apply, so your tax is due. So if we just run through the left hand side, so lent to unconnected third parties at market rent, genuine property development with intent to sell, property held as trading stock in genuine buy sell business, so farmhouse we mentioned, charitable use in furtherance to charity's objectives, qualifying employees or caretaker in occupation, social housing. Where it does not apply, okay, dormant or vacant, connected person, so you've got your mate living there, you've got your family friend living there, or like, your son, daughter, and they're just getting like mates rates. Connected persons in occupation, even if paying rent. Property used as a holiday home by connected persons. Company owns it but no commercial activity. Development stored or abandoned with no active progress. Property acquired for development but retained long term. And director/shareholder using occasionally, even if primarily vacant. So these are just like, I thought I'd put this like, this is a bit of like a side note, but where your relief applies, where it doesn't apply. So I hope this helps. So even though you have full relief, you must still file. This is something worth noting. And some complexities come with this. So scale compounds the burden, and you need to file the relief for each property individually. So let's say, for example, you've got 10 properties in one company. You can't do one filing for all 10 properties under the company. You've got to do 10 individual filings, even though it's under one company. So that creates a bit of an admin burden on your end. Void periods and refurbishments matter. So periods where property is unlet or undergoing refurbishments can temporarily affect relief eligibility, changing your filing position mid-year. So you may find that, let's say you have a tenant move out and you've got like 2 or 3 months where nobody's renting, you may have to file and pay a prorated rate for those 2 or 3 months where there's no tenant, there's no business going on in that property. And penalties even apply when no tax is due. So HMRC will issue penalties for missing or late returns, whether or not charge is payable. Okay, some filing key facts. So again, file per property, not per company. If you've got 10 properties in one company, it is 10 sets of filings, not one, sadly. The filing deadline is the 30th of April, so it's completely different to all other taxes out there. Completely separate from self-assessment. Filed and is paid in advance, not in arrears. I'll give you an example here. So you own a property and on the 1st of April 2026, your return and any payment are due by the 30th. So 30th of April, covering the full year ahead. So you pay, you register here, you pay on the 30th, and it covers the next year ahead. So you're paying in advance, essentially. And if you buy a property mid-year, you have 30 days from purchase to make this, to make the filing. So you complete purchase on 15th September 2026. Your return due is date a month later on 15th of October 2026. Some questions: how do you file? You can file it yourself via HMRC's ATED online service. Authorize an accountant like myself to help file on your behalf, and each property is submitted separately. No bulk option, sadly. So the key takeaways is, in scope from day one, company owned property over 500k. Relief is available. Arm's length buy to let can qualify for relief. File every year. Some things to know. And then if you have any questions, please feel free to reach out. This is my name. This is my email, phone number. And if you scan the QR code, you jump to our website. So you can find out a bit more about me, about the company. And yeah, let me know if you have any questions. More than happy to help. The main thing is, remember these reliefs. So relief is available if you've got property rental business, you're a property developer. The main reasons why you wouldn't get relief is if it's a holiday home. You're using it for 2-3 weeks out of the year and the rest of the time is dormant. But if it is for the purpose of business, you should be filing to get the reliefs. Cool? Any questions, let me know.